The Russia-Ukraine crisis and tension is all over Wall Street as well. What's it mean for the markets, and what should you be doing about it? I got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, it's been a turbulent few weeks on Wall Street and added by the conflict between Russia and Ukraine. And so my question is that I'm posing for this video is, well, wait a second, how could that, how will that, why is that impacting the stock market? Now, let me get this out of the way right now. If you go back through history, conflicts and wars, stock market usually does pretty well. And there's a couple reasons for that. Number one, stock market traditionally does do well. Yes, there are pockets and times when you experience declines, corrections, bear markets, of course. But over long periods of time, stock market generally does well in most environments. But the second reason is the stock market usually does well during conflicts and wars because the government's spending a lot of money, right? And businesses are adapting what they're doing to start to make materials and weapons and whatever else, right? The materials needed for that conflict. And so typically all of that spending creates a lot of economic activity, and that's positive for the stock market. But thus far, things have been pretty turbulent on Wall Street because of the tensions, what's happening with Russia and Ukraine. Why is that? What could this mean for the markets? The first thing that it means to the markets is uncertainty, and the markets do not like uncertainty. Now, I'm going to qualify that with the markets are just fine with uncertainty as long as the Fed is printing money. As long as the Fed has their foot on the gas, or like we had the last time we had great uncertainty during the pandemic, where the Fed was standing on the gas, on the accelerator, markets were fine with uncertainty, no big deal. But when the Fed backs off of that unprecedented behavior, markets don't like uncertainty. In fact, there's a growing narrative right now that all of this uncertainty with Russia and Ukraine is actually going to have the Fed back off of their original, intention to start tightening the economy and raising interest rates. That's interesting, right? So that's where bad news equals good news. If you've been around long enough, it might be confusing where sometimes bad news, the market goes up. Well, we've seen a little bit at periodic times where the markets reverse course, specifically the day after Russia officially invaded. The markets were way down overnight during the futures, and then actually rebounded a bit after the start of the day because, well, geez, this is terrible news. This is awful news. Maybe the Fed will help. But by and large, the conflict between Russia and the Ukraine is creating lots of uncertainty at a time when the Fed has been doing unprecedented measures to stimulate the economy, and they're saying, no, we've got to reverse that. We've got to start tightening. So that to me is making it very problematic, creating a lot more uncertainty and going to create a lot of volatility in the markets, which we've already been seeing. The second implication of the Russia-Ukraine conflict on the markets is skyrocketing oil. We've seen oil at the time I'm recording this, not sure when you're seeing it, and gosh, news is moving fast, but at the time I'm recording this, oil's up near 100 a barrel. Now, a year ago, just for perspective, a year ago it was around 60. Before the pandemic, it was around 55. And so we've seen oil spike almost 30% just year to date. And at the time of recording this, we're just a couple months in. So oil spiking, why is that such a big deal? Well, obviously the oil industry is huge, but that's not going to disrupt the entire market. Every business, every market uses oil, is dependent on oil. Okay, and yes, we're trying to get to energy independence and all that sort of stuff, but we're not there yet. And so as the price of oil moves, that's going to impact the travel industry. That's going to impact consumer behavior because gas prices may be going up or other things might cost more. It impacts everyone. And so there's even some economists that say, yeah, I'm watching the markets, whatever. But to me, the trigger, when oil gets above 80, that's when I start getting concerned that things might start slowing down in the economy because too much margin, too much money is going to need to go towards oil because the price is that high. Guys, we've spiked almost 30%. We're up 100% from pre-pandemic levels, around 100. That's problematic and creating some volatility in the markets. And then the final way that the Russia-Ukraine tension is creating some havoc on Wall Street, or why, is because of sanctions. Basically, all sorts of threats that, well, Russia, you're doing this, now we're going to limit or restrict this. And when that happens, it might all be for, it's certainly necessary, but what that does is starts limiting economic activity. And when you limit economic activity, because the stock market is pricing stocks, pricing companies based on perpetual kind of futuristic growth and revenue and profits, when all of a sudden there's sanctions being mentioned or being carried out that start to limit economic activity, that creates a cloud or starts to discount some of those future projections, okay? So yeah, I'm not gonna get into it, but I mean, if the sanctions are appropriate as a retaliation to what Russia's doing, it does have an influence on economic activity. And the markets aren't going to like that as well, because again, those sanctions could restrict and limit economic activity. So there you have it. I mean, that's why if you looked at this market and said, wait a second, I thought the stock market usually does well during conflicts and during wartime. Why are we having this much volatility? Well, those are the three reasons, right? A lot of uncertainty at the time the Fed is planning to tighten, okay? We've got oil that has absolutely skyrocketed. That's going to impact things. And the sanctions create another layer of uncertainty and could restrict economic activity. Trade this carefully, okay? If you're a trader, stick to your system. But for you long-term investors, that's who I'm talking to. You long-term investors, make sure that your risk tolerance is connected to your overall financial plan. You shouldn't be at a spot where you're taking too much risk. Does anyone like volatility in the markets? No. But if you're a long-term investor and you're still saving, you should, because you're able to buy more at discounted rates, okay? So work with your CFP. Make sure you've got the right approach to your investments and the right risk tolerance, and that it's all connected to the goals you're trying to achieve. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com, that's Korhorn with K, wisemoneyshow.com, you can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.